Welcome to this explainer. Today, we're tearing into one of the most fiercely debated stocks on the entire market right now, Rocket Lab. We are cutting straight through the noise, checking our emotions at the door, and looking strictly at what happens when undeniable future potential collides with cold, hard market history.
$40 billion. That is the massive valuation this company currently commands, and that's despite the fact that, they've never actually turned a profit. To make things even wilder, the current share price of $64.95, that's actually down 56% from its all-time peak. So we have a stock that saw this absolute meteoric rise, a massive crash, and yet still holds a valuation that literally makes traditional analysts sweat.
So what are we really looking at here? Are they genuinely the next SpaceX? Are they rewriting the rules of the aerospace industry and offering us unprecedented potential? Or are we staring down a massive value trap? The mystery really deepens when you look at some of the recent headlines. On one hand, the company just locked down a massive $266 million Space Force contract. Huge win, right? But on the other hand, founder and CEO Peter Beck just sold off nearly $100 million worth of his own stock.
To solve this puzzle, we're going to use a hype versus history framework. Here's our agenda for today. First, Rocket Lab's space empire, then Warren Buffett's value verdict, after that, Peter Lynch's growth test, followed by Ben Graham's defensive checklist. We'll then move on to running the traditional numbers, and finally, wrap it up with hype versus fundamentals.
Okay, Section 1, Rocket Lab's space empire, the undeniable bull case.
To really grasp the hype, you have to listen to this reality check from founder Peter Beck. He points out that despite billions of dollars pouring into the sector and over 100 different companies trying their absolute hardest to conquer orbit, only 2 companies have actually popped out the other end with regular, reliable, scaled orbital launch capabilities. One, obviously, is SpaceX. The other is Rocket Lab. That is a massively exclusive club.
And they are using that exclusive status to build a total empire. Rocket Lab isn't just a company that launches rockets anymore. They are a formidable end-to-end space company. Just look at these wins. They're sitting on an all-time high of over 70 launch missions on their manifest. They have a staggering $2.2 billion backlog of contracted work. Their Q1 2026 revenue hit $200 million, which, by the way, is a 63.5% year-over-year growth rate. And let's not forget, they recently announced a monumental $8 billion acquisition of Iridium Communications. They build the satellites, they launch them, and they provide the services from space, the whole shebang.
But we do have to bring that rocket-fueled excitement back down to earth for a second. Here is the cold, hard reality sitting on their balance sheet. They have never made a profit. We're looking at 5 straight years of losses, with $198 million burned in 2025 alone. And as you know, you can't pay the bills with revenue growth forever. Eventually, the bill comes due. So let's run this current unprofitability through some of the most rigorous valuation tests in history.
Which brings us to Section 2, Warren Buffett's value verdict, moats and margins.
Let's put Buffett's famously strict rules head-to-head with Rocket Lab's reality. Buffett wants at least 10 years of consistent profits. Rocket Lab has 5 years of losses. Buffett demands a return on equity above 15%. Rocket Lab's ROE is currently sitting at negative 13.5%, which literally means they are burning shareholder capital. Now, what about an economic moat? Well, Rocket Lab is the clear number 2 in the space, for sure, but SpaceX still holds over 90% of the launch market, so that moat isn't exactly fully tested yet. However, they do pass the debt test brilliantly. With $1.38 billion in cash and a debt-to-equity ratio of just 0.25, Buffett would absolutely approve of how they are managing their balance sheet.
But despite that pristine balance sheet, Buffett's ultimate verdict would be a firm not yet. He's going to wait for consistent, positive free cash flow. If we play along and assume Rocket Lab eventually scales to $1 billion in annual profit, and then we apply Buffett's standard 30% margin of safety, his calculated buy price sits somewhere between $14 and $19 a share. Compare that to the current $65 price tag, and you're looking at a 70 to 80% drop. As the Oracle of Omaha famously says, price is what you pay, value is what you get. Right now, you're paying an awful lot for very little current earnings.
Moving right along to Section 3, Peter Lynch's growth test, categorizing the fast grower.
Now, Peter Lynch would instantly categorize that 63.5% revenue growth as a classic fast grower. And to value those fast growers, Lynch relies heavily on the PEG ratio. That's the price-to-earnings ratio divided by the growth rate. His golden rule is that this number simply must be under 1. But here's the roadblock. Because Rocket Lab has negative earnings, their PE is negative.
We literally cannot calculate a meaningful PEG ratio. Lynch's framework effectively comes to a grinding halt here because in his view, you just can't value what doesn't make money.
Therefore, Lynch's verdict would be a halt. He would absolutely love their incredibly strong current ratio of 4.47 and those massive cash reserves, but he'd also be side-eyeing that mixed signal of founder Peter Beck selling 1 million shares. Sure, it was under a prearranged 10b5-1 plan, but a significant insider sale is still a significant insider sale. Lynch would sit on the sidelines and wait for consistent profits. Once they cross that threshold, his estimated buy price would land somewhere around $20 to $30 a share.
Section 4. Ben Graham's defensive checklist. The strict value father. Brace yourselves, folks, because this one is rigorous.
Graham's standards are brutally tough on a high-growth, zero-profit tech stock. While Rocket Lab does pass on adequate size with its $40 billion market cap, and they clearly pass on strong financial condition, look at the rest. It completely fails his tests for earnings stability, dividend record, earnings growth, and moderate PE and price-to-book ratios. Passing only 2 out of 7 criteria means any investor strictly utilizing Graham's methods would immediately walk away.
So Graham's verdict is a hard avoid. In fact, Graham's intrinsic value formula literally breaks due to Rocket Lab's negative earnings per share. Even if we plug in some wildly optimistic estimates for 2027, say 10 cents of EPS and a $5 book value, Graham's strict math yields a maximum buy price of just $1 to $5. To Graham, paying $65 for this profile is completely out of the question. Okay, so the historical gurus clearly hate the current valuation. Let's step away from them and see how modern Wall Street math views the stock.
Section 5. Running the traditional numbers. DCF and comparable analysis.
All right, to build a discounted cash flow model for a company that's currently burning over $300 million a year in free cash, we have to make some serious assumptions about the future. We project a 10-year forecast starting at 30% revenue growth, and we taper that down to 10%. We assume they'll eventually hit a really healthy 15% target margin. We apply a 10% weighted average cost of capital to account for the high risk involved and a 3% terminal growth rate. Now, when you run all those realistic future numbers back to today's present value, this base case spits out a fair value of just $13.40 per share.
And honestly, if we skip the DCF entirely and just look at comparable companies, the story doesn't get much better. The broader aerospace and defense industry averages roughly 3 to 8 times sales. Even the absolute highest growth space companies trade at a maximum of 10 to 20 times sales. Rocket Lab? They are currently trading at a staggering 66 times trailing sales. They are completely dwarfing the rest of the industry.
Section 6. Hype versus fundamentals. Synthesizing the data.
Here's the crucial point. Just look at this shockingly consistent verdict across every single framework. Buffett says $14 to $19. Lynch says $20 to $30. Graham says $1 to $5. Traditional DCF and comps say $9 to $23. Every single historical and traditional valuation method is miles away from the current $64.95 price. Now, to be fair, it's worth noting that Morgan Stanley recently issued a massive bull case target of $293, which just goes to show how much future potential some analysts truly see here. But based strictly on today's math, the disconnect is undeniably massive.
When we aggregate all of this fundamental analysis together, the only mathematically sensible buy zone for value-conscious investors is right around $15 to $20 a share. What you really need to take away from this is that, at current prices, the market is pricing in absolute perfection. The current stock price assumes flawless execution of their new Neutron rocket, seamless integration of that $8 billion Iridium acquisition, incredibly rapid profitability, and 0 delays or failures. And as we all know, space is hard and perfection is rare. Which leaves us with one final, massive question to consider. Is Rocket Lab a modern marvel that is fundamentally rewriting the rules of aerospace, basically rendering all these old valuation models completely obsolete? Or is this just a classic case of market hype blinding us to the fundamental math? You have to weigh the undeniable potential of a true end-to-end space monopoly against the cold, hard realities of negative cash flow. Remember Buffett's golden rule: price is what you pay, but value is what you get. So ask yourself, what are you really getting at $65 a share, and ultimately, will the history books or the hype be proven right?